Welcome back. A major U.S. tech accelerator ruffled feathers recently when it said it would no longer invest in companies based in Canada. Is this a sign of economic sovereignty at play, a kind of reverse elbows up that might make it harder for Canadian startups? John Ruffolo is managing partner of Maverix Capital. John, great to have you with us.
Great. Thank you, Amanda.
So Y Combinator, well known in kind of the tech accelerator space, maybe not to a broader audience, but it did raise eyebrows. Is this a kind of a weird, wrapping in the flag issue, or is it about something else in your view?
Yeah, it's about something else. I think people's immediate reaction was, uh-oh, is this another one of those geopolitical tit for tat? But when you started to dig down deeper, there was really something else at play here.
And of course, capital is a pretty important part of the picture of developing Canadian champions. You've been a huge part of that over time at Maverix Capital, previously at OMERS, at the venture group there. How are we doing, John, in terms of getting the lifeblood of capital to Canadian startups?
Well, this is really the underlying issue and the real sensitivity. Really, ever since the COVID crisis, this has been really on a downward trend. And here we are, talking about the biggest topic at hand is rebuilding Canada, Canadian economic sovereignty, but it takes capital. And the capital that we have in Canada is needed in Canada to build these startups. And what happens is when this capital goes elsewhere and we think that foreign-based capital is going to come into Canada to plug any hole, the reality is every single country in the world, including the United States and China, is looking at their own sovereignty issues, and they're protecting their own domestic capital as well.
And tell me how much it matters if a company does redomicile, because we see it all the time. Companies move to, it used to be Silicon Valley, now you see a lot of Florida or New York. Does that make a huge, are we losing the talent and all the fringe benefits of having that homegrown entity?
Yeah, so this is really the issue. So the real concern has been the young entrepreneurs who are graduating university are getting increasingly frustrated, and there's been a lot of friction in Canada with them building their companies. So they believe, and in some cases it's true, that by going to a much more friendly jurisdiction where there's a lot of people willing to write checks, it just makes it easier to build the company. And then the moment that the founders decide to leave, then of course the company is not here. And if these become a big win, then Canada loses out. Particularly where Canada was responsible for the training and education of these folks. And then when it's time to realize it's another country that's benefiting, this will be a real detriment to Canada over the long run.
What can we do about it, John? We can obviously encourage investing. Do we encourage our big pension funds to invest more in Canadian startups?
And at the end of the day, if we're not supporting our own homegrown opportunities and talent, it will be gone. Maybe not immediately, but slowly over the course of time.
John, so good to have you. Appreciate your time.
Great. Thank you, Amanda.
John Ruffolo is managing partner of Maverix Capital. Time for the takeaway and papering over a gaping hole. The recent offer from the federal government to help offset the rising cost of food will be well received. Food inflation has remained perniciously high since it took hold post-pandemic. And since food is a non-negotiable item, it's the one that hits everyone and the most financially vulnerable even harder. The GST credit already exists and some 12 million Canadians already qualify. Now rebranded as the Canada Groceries and Essentials Benefit, the payment amounts will rise. For a family of 4 receiving the credit, the difference could be about $700 more this year and then about $300 a year extra for the 4 years that follow on top of the existing credit. It's a means-tested credit, but the thresholds aren't terribly high. Now, the Parliamentary Budget Officer has an estimate of the cost of this inflation fighter. It's more than $12 billion over the 5-year increase period. Again, that's on top of what the government already spends on this credit, which is about $6 billion a year. Is there anyone who will complain about relief at the grocery checkout for hard-hit Canadians? Well, maybe not the relief itself, but the form it's taking. By giving up taxes from some Canadians, the government will either have to collect more taxes from others or borrow the difference. That is just the math. But more importantly, the rebate doesn't actually solve any of the underlying issues that cause food inflation. Some of those are Canada-specific and include concerns about a lack of competition in food retailing. You might also point to monopoly-like positions of some big food companies or the supply management systems that control supply rather than price. But the biggest driving force of the current jumps in food price have more to do with climate change, extreme weather, and trade wars than anything close to home. None of those will be solved by offering financial support at the till. My takeaway? Having clear conversations about what is actually making food prices jump might help us actually tackle the cause itself. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.